Welcome. Today is Thursday, May 12th. I'm Jeff Hughes, Chief Investment Officer at JWH Investment Partners and editor of Alpha Insights. And this is your Daily 5. Today, we're going to attempt to lay out the bear case for stocks going forward, and we're going to try and do it in just 5 charts. We're also going to attempt to explain why this bear market might just be getting started. So let's jump right in and take a look at chart number 1. So chart number 1 really illustrates our economic cycle model. Now, this model was developed based on some work that we did back when I worked for Steve Leuthold. And after testing dozens of indexes, this study actually concluded that the Dow Jones Transportation Average ranks as the single most sensitive stock index related to changes in economic activity. It's actually more sensitive than, say, the S&P 500 and tends to be a better leading indicator of change. So what we discovered actually is that viewing cycles through the lens of momentum can add a lot of clarity. So what we've done is we've detrended 110 years of price data from the Dow Jones Transportation Average. And from that, we can observe a pretty discernible rhythm to the economy. And what you'll see across the middle of that is a blue dashed line that represents a 110-year regression mean. And then the sine wave in red that you see really represents the cycle that we've been able to fit to this data. Now, that cycle of rhythm can best be measured low to low, and it actually comes out to 34 years, which is a Fibonacci number, which is very interesting to us. But, the conclusion from what we're looking here at this model is that we've broken below the regression mean, which suggests a potential for change in the direction of the economic cycle. And, as this long-term structural cycle was slated to peak kind of in this general acceptable range of change here, say 2 to 3 years, this year was kind of right at the forefront of that 2 to 3 year range. And what it appears is the case is that the cycle has indeed peaked and has indeed begun to roll over. And if in fact this is the case, and we'll know if it continues to go lower, then the next cycle low is not scheduled to occur until 2039, which means that this is going to be a structural change in what we've become used to over the last couple of decades, basically. So let's move on to chart number 2 to see what some of those potential implications could be. Chart number 2 takes a look at the 10-year Treasury yield. And this isn't the first time that we've shown this study, but we've tried to isolate it a little bit more. And we've extended it to include the data going back to 1962, which is all the data we have for the 10-year Treasury yield. And what we're looking at here is, first let me explain that the 10-year Treasury yield is probably the single most important factor in affecting asset price valuations. It's part of the capital asset pricing model. You need a risk-free rate. And since rates have been kind of manipulated by the Fed, it's been the 10-year bond yield that's really been that risk-free pricing mechanism for the last 13 years or so. And what we're seeing today is a very discernible break above a 40-year downtrend line that has really defined the 10-year bond yield going back to 1981 or so. And the break above that trend line is significant because, number one, it's the first time it's occurred. Number two, it occurred on a monthly closing basis, which means that we can't see it shift back lower and the trend holds intact. It's now changed the entire picture permanently. And the other thing that's important in our view is that we're now poised to challenge the 2018 high of around 3.25. And what we've suggested at this point is that if in fact yields do inflect above that 3.25 level, then we could definitely see a new advance begin. And I don't expect this to occur immediately by any stretch. In fact, we rallied right into kind of that 320-ish area the other day, and we've backed off. And I fully expect this 2018 high to act as resistance. And what that means is that there should be some backing and filling here. And I couldn't really be specific about how deep we could see retrenchment in the yield. It wouldn't surprise me to see a pullback to 2.5%, maybe 260. But back and forth over the next several months, if not year, before we then make some form of significant challenge of that 3.25 resistance level. And once that's broken to the upside, a sustained bullish inflection above that would project a measured move to approximately 6%. Now, just given the historical relationship between Treasury yields and inflation rates, and taking a look at the inflation rates that we've seen, whether they've peaked or whether they haven't peaked, we don't know at this point, but we do know that CPI headline inflation is north of 8%, and PPI headline inflation is coming in at 11% most recently today. These are unacceptably high numbers, and they are persistent. And we think that there's a high probability that this inflation could remain persistent for some time. And if in fact it does, the Fed will have to take action. Indeed, they will have to be much more aggressive in getting to a neutral level on their Fed funds rate in order to contain inflation and bring it back to earth. Their target rate of 2% is so far out of the realm of possibilities near term that it seems very likely that we're going to see several hundred basis points of tightening before we get there, and that should result in yield creep on the 10-year bond yield. And we think that this yield creep will result in much higher rates looking out the next couple of years. So let's take a look at chart number 3 to see what's happening in the stock market as a result of these broader macro issues. Well, first of all, we would note that equity prices have broadly responded to this change in economic activity and the rise in interest rates. We've seen this since the January 4th peak in the S&P 500 at 48.18, and we've pulled back some 18% or so as of today's low. Now, investors are revaluing the companies in their portfolios based on these prevailing conditions. And what we're seeing is PE multiples now having contracted from a high of 22 times forward 12-month earnings back on January 4th to just 17 times today. That's 5 multiples of compression. But we don't think that's complete. We don't think we've reached the level that's appropriate at this point. In fact, because we expect to see policy withdrawn, meaning that we're going to see the Fed's balance sheet run off slowly but surely. It could be death by 1,000 cuts the way they're describing it at this point. But we're at 8 trillion plus, almost 9 trillion in assets on the Fed's balance sheet, up from 4 trillion before the pandemic. And it would not surprise us if the Fed were to get back to that 4 trillion over the next couple of years. And as that occurs, that's consistent with this rise in interest rates that we would expect as well. And it should result in more PE multiple compression as well. But market technicians have been able to observe this step function by simply looking at the pattern that's developed in the S&P 500. And what we see here as technicians is a classic pattern top formation of the head and shoulders variety. Now, we were able to identify this early and position in anticipation of this change as we saw key moving averages like the 20-week and the 30-week broken sustainably. And then we also saw the 20-week inflect below the 30-week, indicating almost like a sell signal. But what we're seeing today is a breach of chart support and trend support at 4,300 just a couple of weeks, 3 weeks ago. And that really confirms this pattern. And there's a number of ways that you can draw the line. We've just chosen to be very, parochial about it. And we put a horizontal trend line off the October lows across, and we're counting down from those January highs to the October, January, February lows on a closing basis. And we can project a low down to around 3,800 or so. However, The right shoulder is what we would call a weak right shoulder. And the orthodox way of counting a head and shoulders measured move would be to connect the neckline across those shoulder blades, if you will. And so it should be, a weak neckline. In other words, a slanted neckline down into the right. And counting off of that angled descent gets us closer to around 3,500. And so we think that while 3,800 is a reasonable place to expect some support, it's a 38.2% retracement of the advance off the March 2020 low. It also represents a 50% retracement if we get to 3,500. So those are pretty good stopping points. But there's another way that we should really kind of take a look at this from a bigger picture perspective, and that brings us to chart number 4. And chart number 4 is really our Elliott wave analysis, going back to March of 2009, really to get some sort of a bigger picture of what's really going on here. And the chart on the left side looks at what we would describe as cycle wave 5. It's the March 2009 to January 22 advance. It's a 5-wave advance that terminated at least cycle degree and possibly super cycle degree, right in line with our published target of 4,800. It has subsequently begun to turn down in 5 waves, which we would define as the initial move or intermediate wave 1 down, followed by intermediate wave 2 up into the March 29th high, which was around 46.37. Now, we've turned down from that level, which again brings us to the point where we're at today. We think we're in intermediate wave 3 down, and this is probably going to be a rather dynamic decline that should take us substantially lower. If we decline at 161.8% of the wave 1 decline, it would take us exactly to 3,500. We have that marked as our wave 3 target, which means it's not over, folks. And in fact, if you look back to the chart on the left-hand side, you can see that just to correct that advance off the 2009 low, a Fibonacci 38.2% retracement would get us to around 3,200, a 50% retracement to 2,700, and a 61.8% retracement would bring us all the way back to around 2,250 or so. Now, what makes us especially nervous is chart number 5. The last man standing in this market was Apple. And chart number 5 shows you that Apple is the largest weighting in the S&P 500 at 7%. It is still trading at almost 26 times forward earnings and 7 times trailing sales. And this stock has broken. It has developed these characteristics of a classic double top formation. It's breached its trend line in January and just breached chart support at 155. And if that is sustained, it projects a measured move to 120. When Elvis was performing in Vegas, the audience wouldn't leave the show until they heard these words: Elvis has left the building. In my opinion, Apple is the Elvis of the stock market right now, and it has left the building. That's all I have for today, folks. Thanks for joining us. If you'd like to follow up with me, you can follow me on Twitter at @alpha_insights, or you can find me on OETV at Alpha Insights, or on LinkedIn, or just go to my website, www.jwhinvestment.com. Thanks a lot for watching.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.